Welcome to this revision explainer. Today, we are systematically guiding you through the actual scaffolding of a business. We're going to build your knowledge straight from those foundational legal concepts all the way up to some pretty complex financial mechanics. Let's dive right in. Here's our roadmap for today. First up, we'll tackle liability and risk profiles. Then, we'll explore specific ownership structures, followed by evaluating public limited companies. And finally, we'll wrap up with share formulas and calculations. Okay, Section 1. Liability and risk profiles. We're starting at the very foundation of any business structure, the legal realities of liability and risk. Now, the absolutely crucial point here is understanding this one core distinction. Unlimited liability, that means as an owner, you are personally on the hook for all business debts. Literally, your personal assets, your house, your savings, they can be legally seized to repay those liabilities. On the flip side, limited liability acts as a legal shield. Your financial responsibility is strictly capped at the amount of money you originally invested in the business. Your personal wealth, that stays protected. But there is a massive trade-off here. Operating as a sole trader with unlimited liability might seem way simpler to set up initially, but it carries a remarkably high personal risk. And because of that risk, it's significantly harder to attract external investment. Moving to a limited structure fundamentally lowers that personal risk profile. Because investors know their own personal assets are completely protected, this structure becomes highly attractive when you're looking to raise capital and really grow. Let's put this into practice right away. To actively test your AO3 analysis skills on this foundational concept, pause the explainer now and complete task 1. Moving right along to Section 2, exploring ownership structures. Let's see exactly how that legal foundation we just talked about dictates the actual, real-world forms of business can take. When we compare these forms across control, objectives, and the distribution of profits, which, by the way, is a key requirement of your AQA specification, some distinct differences really emerge. A sole trader maintains absolute control, but usually operates on a pretty limited scale. A private limited company, or LTD, keeps control within a restricted group of shareholders while enjoying that vital limited liability shield. And then we have cooperatives, which are distinctly owned by their members, meaning the profits are actively shared right among them. Let's look a bit closer at those cooperatives. If a business really wants to prioritize collaboration and democratic decision-making, they might form one of 3 specific types. They can uniquely be structured around the workers themselves, the consumers who actually buy the products, or the producers who supply the goods. In all these cases, the focus is firmly on shared member goals, not just maximizing returns for outside shareholders. Alternatively, you've also got to be ready to discuss social enterprises. These are fascinating because they completely flip the traditional business paradigm on its head. They measure success not just by pure profit, but by their positive impact on society and the environment. They literally have specific social or environmental objectives baked into the very core of their operations. All right, Section 3, evaluating public limited companies. Now we scale up to the absolute top tier of business structures to evaluate some serious strategic trade-offs. By trading shares on a public stock exchange, a PLC gains incredible access to massive capital from a huge range of investors. I mean, this is the ultimate engine for rapid corporate expansion. But it comes at a heavy cost. You face the loss of take control, the constant looming threat of hostile takeovers, and you have to comply with incredibly strict ESG, that's environmental, social, and governance, and financial transparency reporting. It's a whole new ballgame. Let's walk step by step through how this actually plays out in the market. Step 1, a business incorporates and issues shares primarily to fuel growth and raise capital. Step 2, investors buy into this business seeking a return. That's usually a portion of the profits, called a dividend, plus an appreciation in their overall wealth. Step 3, once those shares are out in the wild, the share price constantly fluctuates based on shifting market conditions and, of course, the company's actual financial performance. So, time to test your AO4 evaluation skills by weighing these massive strategic trade-offs. Pause the explainer now and complete task 2. And we arrive at Section 4, Share Formulas and Calculations. For our final section today, we are going to slow things down a bit and meticulously deconstruct the quantitative financial mechanics you need for the highest levels of your exam. There are 3 formulas that represent the absolute core of financial valuation for a PLC, and you must be able to confidently calculate, interpret, and analyze all of them: market capitalization, dividends per share, and dividend yield. Let's break them down. Let's dive into market capitalization first. This is simply the total current value of the entire company on the stock market. You find it by taking the current share price and multiplying it by the total number of shares in existence, also known as issued shares. It basically tells us exactly what the market thinks the business is worth right this second. Next up is the dividend yield. This metric is absolutely critical for investors because it shows the direct return on their investment. You calculate it by taking the annual dividend per share and expressing it as a clean percentage of the current market share price. A higher yield, well, that usually indicates a much better immediate return for the shareholder. To really bring this to life, let's look at some simulated company data containing exactly the variables you need for these calculations. Let's say we have a current share price of £2.50. There are 10 million issued shares, and the annual dividend per share sits at 0.15. Now, put your AO2 application skills to the test by extracting the right numbers from those figures and applying the formulas. Pause the explainer now and complete task 3. Welcome back. As we wrap this up, the big picture you should really take away from today is how deeply interconnected all these concepts actually are. Think about it. The legal scaffolding of liability defines your risk. That risk dictates your structural form. Your structural form influences your overall control and strategy. And finally, that strategy drives your financial valuation. It is just one continuous chain of cause and effect. I'll leave you with this final thought to ponder for your exams, especially when you're evaluating these topics in the real world. If you were launching a highly innovative, deeply ethical tech startup today, how would you balance the aggressive need for growth capital with the fundamental desire to protect your original business mission? Which specific ownership structure would you choose? Think about it. Good luck with your revision.